Hey there, welcome to Ground of Life Investments, where we talk about building a secure income generating retirement. I'm Rob, and I've been traveling the world full time, living off dividends and investments. Today, I'm coming to you from Cambodia, and I'm excited to share that I just invested $10,000 in the Schwab US Dividend Equity ETF, ticker SCHD. If you're looking for steady income to enjoy your retirement, stick around because I'm breaking down exactly how much this investment pays me, what makes SCHD a solid choice, and why it's a great long-term hold for retirees like you. Let's dive in. As always, I am not a financial advisor, and this video should not be taken as financial advice. Please do your own research and make your own decisions. First up, let's talk money. Specifically, how much income can you expect from a $10,000 investment in SCHD? As of May 2025, SCHD boasts a dividend yield of around 4%. Now that's pretty attractive for retirees looking for reliable cash flow. So what does a 4% yield mean for $10,000? Well, simple math. 4% of $10,000 is $400 per year in dividends. Break that down monthly, and you're looking at about $33.33 per month. Now, I know $33 a month doesn't sound like a game changer, but think about this. That's passive income paid out quarterly without you lifting a finger. And if you're investing more, say $50,000 or $100,000, that's $2,000 or $4,000 a year, or $166 to $333 a month. Now, that's real money for cruises, grandkids, or just covering the grocery bill. SCHD pays dividends quarterly, so you'll see those payments hit your account every 3 months. For $10,000 invested like I have, that's roughly $100 every quarter. It's like clockwork, and for retirees, that predictability is gold. Plus, SCHD has a history of growing its dividend over time, so that $400 a year could increase as the fund's underlying companies raise their payouts. More on those companies coming up soon. Now that you know the income potential, let's look at what's inside SCHD and why its holdings make it a smart buy, especially during this market dip. SCHD tracks the Dow Jones US Dividend 100 Index, which includes 100 US companies with strong dividends and solid financials. The fund's top holdings right now include household names like ConocoPhillips, Coca-Cola, Verizon, Lockheed Martin, Altria, Home Depot, AbbVie, Cisco Systems, and Chevron. They each make up roughly 4% of the fund. Now, these aren't flashy tech startups. They're established, profitable companies that are paying dividends for years, perfect for retirees like us who value stability. Let's dive into a few of these and see why they're going to be great for your retirement portfolio. Coca-Cola is a consumer staples giant. It's also a retiree's dream. It sells beverages worldwide, and people buy Coke whether the economy is booming or busting. Its consistent cash flow supports a reliable dividend, which SCHD passes on to you. Similarly, PepsiCo, another consumer staples holding, offers snacks and drinks that are always in demand, ensuring steady payouts. Verizon, in the communications services sector, is another standout. It's one of the largest telecom providers in the US, keeping us connected with phone and internet services. For retirees, Verizon's dividend is like a utility bill you get paid for, reliable and backed by a massive customer base. ConocoPhillips and Chevron, both in the energy sector, are equally compelling. They're major players in oil and gas with diversified operations that weather any market swing. Even with energy price volatility, their strong balance sheets ensure that they keep paying dividends, which is critical for your income stream. Lockheed Martin, an industrials leader, is a top defense contractor with long-term government contracts. Retirees love this kind of stability, as Uncle Sam is a pretty reliable customer. Home Depot, in consumer discretionary, benefits from homeowners sprucing up their properties, a trend that holds up even in tough markets. Its dividend growth reflects its strong sales, making it a great fit for SCHD. AbbVie, a healthcare powerhouse, is another gem. It's blockbuster drugs like Humira and a pipeline of new treatments. With an aging population, healthcare demand is only going up, making AbbVie's demands a safe bet for retirees. Cisco Systems and Information Technology provides the networking gear that powers the internet. Its steady contracts with businesses and governments mean consistent cash flow, translating to dependable dividends. The sector breakdown ties all this together. SCHD is diversified with about 20% in consumer staples, 18% in healthcare, 15% in energy, 12% in industrials, and 10% in information technology, plus some smaller allocations to financials, consumer discretionary, and others. This mix does balance stability and growth. Consumer staples and healthcare are defensive. People need medicine and food no matter what. Energy and industrials offer exposure to economic recovery, which is key during a market dip like we're seeing now. So why buy SCHD during a dip? When stock prices drop, dividend yields rise, meaning you can lock in that 4% yield at a lower price. Plus, SCHD's companies are financially strong, with consistent cash flows to sustain dividends. This makes SCHD a bargain when markets are shaky, as you're buying quality at a discount. So SCHD's income and holdings are compelling, but why it is a great long-term holding for retirees? Let's talk about that for just a minute. As retirees, you want investments that are low stress, reliable, and built to last. SCHD checks all those boxes. Here's why I think it's a fantastic long-term hold. First, SCHD's focus on dividend-paying companies means it's designed for income. The fund selects firms with at least 10 years of consecutive dividend increases, like Home Depot, Cisco, and AbbVie. These are companies with staying power, not fly-by-night operations. This focus on quality reduces risk, which is crucial when you're living off of your portfolio. Second, SCHD's diversification across sectors cushions it from market volatility. If tech takes a hit, consumer staples or healthcare can hold steady. This balance helps protect your income stream so you're not sweating every market headline. Third, SCHD has a low expense ratio of just 0.06%. That means for every $10,000 invested, like I just did, you pay only $6 a year in fees, and that's pretty incredible. Compare that to other funds charging 0.5% or more, and you're saving hundreds over a decade, keeping more of your money working for you. Looking ahead, I'm bullish on SCHD's future. Its companies are well positioned for long-term trends. Healthcare, with names like AbbVie and Bristol Myers Squibb, benefits from an aging population needing more medical care. Energy firms like ConocoPhillips are critical as global energy demand grows. And consumer staples, people will always buy Coke and cereal. Plus, SCHD's dividend growth has historically outpaced inflation, helping your income keep up with rising costs. For retirees, SCHD is a set-it-and-forget-it investment. You get steady dividends, low fees, and exposure to America's best companies all in one package. It's not about chasing hot stocks. It's about building a reliable income stream for your retirement lifestyle. So there you have it. My $10,000 in SCHD pays me $400 a year, or about $33 a month, from a diversified mix of rock-solid companies like Coca-Cola, Verizon, and AbbVie. It's a smart buy during market dips and a long-term winner for retirees thanks to its income, low fees, and growth potential. If you're looking to boost your retirement income, SCHD is worth a serious look. So let me know what you think about SCHD. If you have some already, or if you're planning to pick some up in the next few weeks, drop a comment below. Let me know what other ETFs you're eyeing also for your retirement portfolio. If you like this video, please give me a like, subscribe if you haven't already, and I'll see you on the next video.